PAXG and Mexico are raising alarms. Why silver could surge higher? Mexico is not just in crisis, it is bleeding into the global silver supply. The world's largest silver producer is under military lockdown, and PAXG, the asset that smart money moves before the storm hits, is already screaming. But here's what no one is telling you. The paper price of silver still assumes everything is normal. It is not. And when that gap between reality and price finally closes, what happens next could change everything you thought you knew about where your money should be sitting right now. Welcome to Financial Crisis Explained, the one place where the dots get connected. That mainstream financial media simply refuses to connect for you. Now, before we go any further, if you have not subscribed yet, think of it this way. You would not skip your morning newspaper for 30 years straight, would you? This channel is that newspaper, except it arrives before the crisis makes the front page. Hit that subscribe button. It takes 1 second, and it may save you from years of financial regret. And one more thing. Drop in the comments right now. Where in the world are you watching this from? Whether you are in Karachi, London, Dubai, or sitting quietly somewhere in the American Midwest, we want to know. Because this story affects every single one of you differently. Now, let us get into it. Sunday evening. Markets closed. Most investors are watching television, planning their week, completely unaware of what is developing thousands of miles away in a country that quietly controls one of the most critical raw materials on the planet. Mexico is in crisis. Not the slow, bureaucratic kind of crisis that takes quarters to develop and years to fully surface. The kind that moves fast. The kind that does not send a formal announcement before it arrives. Military units mobilized across key regions. Airspace shut down in parts of the country. Commercial flights canceled without warning. And at the center of it all, a significant operation that reportedly eliminated one of the most consequential cartel leaders in Mexico's recent modern history. The political dimensions of that operation are still developing. That is not what this analysis is about. What this is about is something the financial media will not connect for you, something that sits quietly underneath the headlines about military movements and cartel leadership, something that has nothing to do with politics and everything to do with the global economy. Mexico is the single largest silver-producing nation on Earth. Let that settle for a moment. Not one of the largest. Not in the top 5. The largest. Roughly 1 in every 4 ounces of silver mined anywhere on this planet comes from Mexican soil. The mountains of Sonora, Chihuahua, and Zacatecas have been feeding the global silver supply chain for decades. Mines like Fresnillo, the world's largest primary silver mine, operate out of this country. The infrastructure, the logistics, the export pipelines, all of it runs through a nation that is currently experiencing one of its most volatile security situations in recent memory. Now here is where serious analysts separate themselves from casual observers. A crisis in Mexico does not need to collapse silver mining operations entirely to matter. That is a misunderstanding of how commodity supply chains actually function under stress. The mechanism is far more subtle and far more dangerous because of that subtlety. Road blockades slow transport. Logistics companies pull back from high-risk corridors. Insurance premiums on freight shipments spike overnight. Mine workers in affected regions do not show up. Not because they are ordered not to, but because they are afraid. Security personnel get reassigned. Equipment convoys get delayed at military checkpoints. And slowly, quietly, the flow of silver from ground to global market begins to tighten. It does not stop. It constricts. And in a market that is already structurally tight, the constriction is all it takes. This is the part that demands full attention from anyone sitting in a boardroom, managing a portfolio, or building a business that touches any part of the real economy. The silver market heading into this crisis was not sitting in a position of comfort. Speculative long positioning in silver had been running near 20-year lows even as price was making aggressive upward moves. That is an extraordinary divergence. It means the institutional money had not yet fully committed. It means the market had not yet priced in what the physical demand signals were already screaming. The Shanghai premium, the price that physical silver commands in China above the global paper benchmark, had already been signaling that real physical demand was running well ahead of what the paper markets were reflecting. Buyers in China were paying above market price to secure physical silver, not futures contracts, not paper promises, physical metal. That is not a speculative signal. That is a demand signal rooted in industrial reality, solar panel manufacturing, electric vehicle production, defense technology procurement. These are not industries that wait for a better price. They secure supply because they need it, and they had already been competing aggressively for a supply that was tighter than the headlines suggested. Enter Mexico. Enter military mobilization. Enter airspace restrictions. Enter logistics disruption in the country that supplies a quarter of the world's silver. The market was already coiled. Mexico just introduced the uncertainty that coiled markets have been waiting for. And here is the brutal truth about commodity markets that every serious business person must understand. They do not reprice on confirmation. They reprice on uncertainty. They reprice before the supply shock is officially declared. Which means, by the time the mainstream financial media connects these dots for you, the move may have already happened. There's a language that financial markets speak before the mainstream world catches up. It is not spoken in press conferences. It is not written in analyst reports that get emailed to retail investors 3 days after the fact. It does not appear on the ticker scroll of financial television channels. It moves quietly, deliberately, and with a precision that only makes sense in hindsight, unless you know exactly what to look for. PAXG is speaking that language right now. For those encountering this asset for the first time, a brief but critical explanation is necessary. Pax Gold, traded as PAXG, is not a gold mining stock. It is not a futures contract. It is not a speculative derivative layered on top of some financial institution's balance sheet. Each token of PAXG is directly backed by 1 fine troy ounce of physical gold held in allocated vaults in London. It is perhaps the cleanest, most transparent real-time proxy for physical gold sentiment that exists in today's market structure. And that distinction matters enormously, because when PXG moves, and when its price begins to diverge from normal trading behavior, it is not algorithmic noise. It is not retail speculation chasing a headline. It is a signal that informed participants, people with direct access to physical metal markets, are repositioning, quietly, deliberately, before the crowd arrives. PAXG has been raising alarms. Now understand the historical architecture of what happens when gold stress signals emerge with this kind of clarity. Gold and silver do not move in isolation. They are bound together by a relationship that has held across centuries of monetary history, commodity cycles, and financial crises. But they do not move simultaneously. Gold moves first. It absorbs the initial wave of institutional repositioning. It reflects the earliest recognition that something in the macro environment is shifting beneath the surface. Silver follows. But when silver follows, it does not follow quietly. It does not inch upward in polite increments that give patient observers time to adjust. Silver, when it moves in response to gold stress combined with a physical supply disruption, moves with a velocity that compresses months of price action into days. That is not speculation. That is the documented behavioral pattern of this metal across multiple cycles. The gold to silver ratio is the instrument serious analysts use to read this relationship in real time. When gold strengthens aggressively while silver lags, the ratio widens. A widening ratio in an environment of physical demand pressure is not a sign of silver weakness. It is a coiling mechanism. It represents energy accumulating in a market that has not yet made its move. And historically, the resolution of that coiled ratio has been sudden, significant, and deeply rewarding for those who understood what they were watching before it happened. Right now, that ratio is speaking. But here's what makes the current PAXG signal uniquely important, and why it deserves more than a passing glance from serious business people and strategic thinkers. The smart money that moves through physical gold proxies like PAXG is not reacting to Mexico's crisis. It's positioned before the headlines broke with full clarity. That is the nature of informed capital. It does not chase events. It anticipates structural conditions that make certain events inevitable, or at minimum, highly probable. The structural conditions were already in place. Tight physical silver supply, suppressed speculative positioning, Shanghai premium signaling demand running ahead of paper markets, industrial consumption accelerating across sectors that cannot reduce their silver dependency regardless of price. These were the conditions that existed before a single military unit was mobilized in Mexico. PAXG rising in this environment is not a coincidence. It is confirmation. It is the market's most sophisticated participants communicating through the only language that cannot be manipulated by press releases or managed through public statements that something fundamental is shifting in the hard asset landscape. They are not waiting for certainty. They never do. Because in commodity markets, certainty arrives at the exact moment opportunity disappears. Consider what that means for the business person sitting on the sidelines. Consider what it means for the entrepreneur who has been told repeatedly that silver is simply an industrial metal with modest investment characteristics. Consider what it means that the asset class most connected to real physical gold is raising alarms. At the exact same moment, Mexico is disrupting the supply of the world's most industrially critical precious metal. This is not noise. This is the market whispering something that it will soon begin to shout. There's a moment in every major commodity cycle that only becomes obvious after it has already passed. Analysts write about it in retrospect. Financial journalists frame it as something that no one could have seen coming. Portfolio managers quietly restructure their explanations for why they missed it. And the majority of investors, the ones who were watching but not understanding, are left holding positions that reflect yesterday's reality in a market that has already moved into tomorrow. That moment in the silver market may be closer than anyone is publicly willing to admit. But to understand why, one must first understand something that the financial industry has done a remarkably effective job of obscuring from the general public. There are, in practical terms, two silver markets operating simultaneously. They share a price, they do not share a reality. The first is the paper silver market. Futures contracts, exchange-traded products, derivatives layered upon derivatives, a vast financial architecture built on the promise of silver rather than silver itself. This is the market that flashes across trading screens. This is the number that gets quoted on financial television. This is the price that most people believe represents the true value of physical silver at any given moment. The second is the physical silver market, actual metal, refined, allocated, deliverable. The silver that flows from Mexican mines into global supply chains, the silver that gets consumed in solar panel manufacturing facilities in China, in electric vehicle battery production lines in Germany, in defense electronics procurement programs in the United States, the silver that, once consumed industrially, does not return to the market. It is gone, permanently. These two markets have been diverging, and that divergence is the most important financial story that almost no one in mainstream media is telling with the seriousness it deserves. Here is the data that demands attention. Speculative long positioning in silver, the measure of how aggressively professional traders are betting on silver's upside through futures markets, has been sitting near 20-year lows. 20 years. That number requires a pause for full comprehension. In 2 decades of silver market history, professional speculative positioning has rarely been this subdued. And yet, during the same period, silver's price has been making aggressive upward movements. That is an extraordinary contradiction. In normal market conditions, aggressive price movement attracts aggressive speculative positioning. Traders follow momentum. Institutions chase performance. That is the standard behavioral pattern of financial markets operating under normal conditions. But that pattern has broken down in silver. Price is moving up. Speculation is staying low. Which means the price movement is not being driven by paper market enthusiasm. It is being driven by something far more structural, far more durable, and far more difficult to reverse. Physical demand is consuming supply faster than the paper market has acknowledged. The Shanghai Premium confirms this with uncomfortable clarity. For months, buyers in China's physical silver market have been paying prices above the global paper benchmark to secure actual metal. Not futures, not ETF shares. Physical, deliverable silver. That premium does not exist in a market where supply is comfortable. It exists when buyers are competing for metal that is genuinely scarce relative to demand. It is the physical market's way of communicating what the paper price has not yet admitted. Now, layer on top of this the industrial demand reality that does not appear in most investment analyses because it is unglamorous and slow-moving until it suddenly is not. Solar energy installations globally are consuming silver at a rate that is accelerating, not stabilizing. Each solar panel requires a precise quantity of silver for its electrical conductivity. There is no substitute material that performs equivalently at scale. Electric vehicle production, despite its headline volatility, continues to expand the total global fleet, and each vehicle carries silver across multiple critical systems. Defense procurement programs across NATO member states, quietly accelerating in response to a more complex global security environment, are drawing on silver for electronics, communication systems, and precision manufacturing. These are not cyclical demand sources. They are structural. They do not reduce consumption when silver's price rises modestly. They secure supply because operational continuity depends on it. And now consider what happens when this specific combination meets a Mexico crisis, a physical market already running tight, industrial consumers already competing aggressively for supply, speculative positioning so low that any institutional rotation into silver creates immediate upward price pressure with minimal resistance. Shanghai Premium's already signaling that the physical market is ahead of the paper market in recognizing true scarcity. And then, the world's largest silver-producing nation enters a period of genuine operational uncertainty. This is not a setup for a gradual, manageable price increase. This is not the kind of market condition that resolves quietly over several quarters while investors calmly rebalance. This is a coiled market, compressed by years of suppressed positioning, stretched by accelerating industrial demand, tightened further by physical scarcity signals that the paper price has refused to honestly reflect. And Mexico has just introduced the one variable that coiled markets have always needed: uncertainty. Not collapse, not confirmed supply destruction, simply uncertainty. Because in a market this structurally tight, uncertainty does not need to be proven to move price. It needs only to exist. It needs only to make the next buyer hesitate before assuming supply will arrive on schedule. It needs only to make the next industrial procurement officer pick up the phone and ask whether their silver delivery commitment is still intact. That hesitation, that single phone call in a market coiled this tightly, is enough. The gap between what paper silver is priced for and what physical silver markets are already living through is not sustainable. And when that gap closes, it will not close slowly, it will not close politely, and it will not wait for the majority of investors to understand what just happened before it has already happened. There is a particular kind of silence that precedes major commodity repricing events. It is not the silence of a market at peace. It is not the silence of equilibrium, of supply meeting demand in comfortable balance, of investors sleeping soundly because the data suggests nothing urgent is developing. It is a different kind of silence entirely. The silence of a market that has not yet processed what is directly in front of it. The silence that exists in the precise window between when something begins to matter and when the majority of participants finally understand that it matters. That window is where generational financial decisions get made, not after the headlines scream confirmation, not after the television analysts present their retrospective breakdowns of why silver surged and who saw it coming, not after the institutional repositioning has already compressed the entry opportunity into a fraction of what it was just weeks earlier. The window that changes financial trajectories opens quietly, remains open briefly, and closes without announcement. Understanding this sequencing is not optional for serious business people and strategic investors. It is foundational. So let us examine precisely how commodity supply shock sequencing has historically unfolded, because history in this specific domain does not repeat with perfect precision, but it rhymes with a consistency that rewards careful students and penalizes casual observers. The first stage is uncertainty, not confirmed disruption, not declared supply collapse, simply the introduction of credible doubt into a market that was previously operating on the assumption of normalcy. Mexico's current situation represents this stage with textbook precision. Mining operations have not officially halted, export pipelines have not been formally severed, but the conditions that could accelerate toward those outcomes now exist visibly, publicly, and undeniably. The market knows what it did not know 2 weeks ago, and knowledge of risk, even unconfirmed risk, begins repricing assets in real time. The second stage is premium expansion. This is where the physical market separates decisively from the paper market. Buyers who need actual metal, not futures contracts, not ETF exposure, not synthetic silver derivatives, begin paying above benchmark prices to secure supply. The Shanghai premium that already existed before Mexico's crisis intensifies. Industrial procurement officers, the quiet professionals who keep manufacturing lines running and never appear on financial television, begin locking in forward supply commitments at prices above current market. They do this not because they believe in silver as an investment thesis. They do it because operational continuity is worth more to their businesses than the marginal cost of paying a premium today versus facing a supply gap tomorrow. The third stage is paper market acknowledgement. This is the stage most retail investors and casual market observers mistake for the beginning of the move. It is not the beginning, it is the middle. By the time futures markets, ETF flows, and speculative positioning begin reflecting what the physical market has already been communicating for weeks, the first and most significant portion of the repricing has already occurred. The investors who positioned during stage one are already sitting on substantial gains. The investors who waited for confirmation are now chasing a market that has already made its most aggressive initial move. The sequencing is not theoretical. It documented itself during the 2010 to 2011 silver cycle. It documented itself during the March 2020 physical silver squeeze that followed pandemic supply chain disruptions. It documented itself during every major commodity repricing event where physical scarcity preceded paper market recognition. The pattern is consistent enough that ignoring it is not caution. It is a choice to repeatedly arrive late to a market that consistently rewards early structural understanding. Now, here is what serious investors and strategic business people should be monitoring with genuine discipline in the current environment. The gold to silver ratio remains the single most important instrument for timing silver's next major move. When this ratio begins compressing, when silver starts outperforming gold on a relative basis, it historically signals that the institutional rotation from gold into silver is beginning. That rotation, once initiated, tends to be fast and self-reinforcing. Each percentage point of ratio compression attracts additional capital, which accelerates further compression, which attracts more capital. The feedback loop, once established, runs further and faster than most participants anticipate. Physical silver premiums in retail and wholesale markets deserve equal attention. When the spread between paper price and physical delivery price begins widening beyond historical norms, it is the market's most honest signal that supply tightness is real rather than theoretical. Watch that spread. It communicates what the futures price deliberately obscures. Mining equity behavior in Mexican silver producers warrants specific scrutiny. Fresnillo and its peers operate within the exact geography currently experiencing security disruption. Any operational guidance revisions, any insurance-related disclosures, any logistics-related commentary from these companies in the coming weeks will carry information that the broader market will be slow to fully price. But beyond the instruments and the signals and the price levels, there is a more fundamental strategic reality that every business person in this audience must internalize before this video concludes. Hard assets are not simply investment vehicles. They are not line items in a portfolio spreadsheet to be rotated in and out based on quarterly performance reviews. In periods of genuine geopolitical and supply chain stress, the kind of stress that Mexico's situation represents, the kind that PAXG's behavior is signaling, the kind that Shanghai premiums are documenting in real time, hard assets perform a function that no financial derivative can replicate. They hold value when the assumptions that underpin paper markets begin to crack. They provide optionality when supply chains that everyone assumed were permanent suddenly reveal themselves as fragile. They reward the business person who understood, before the crisis was confirmed, that the world's largest silver producer was not an abstraction on a supply chain diagram, but a living, breathing, geopolitically vulnerable reality. The paper price of silver at current levels reflects a world where Mexico operates normally, where supply flows without friction, where the assumptions of yesterday remain the operational reality of tomorrow. That world is no longer the world that exists. Will not remain open indefinitely. Markets price in normalcy until they cannot. And when they can no longer maintain that fiction, they do not adjust gradually, they do not offer polite warnings, and they do not wait for the unprepared to get ready. The alarms that PAXG and Mexico are raising right now are not background noise to be acknowledged and forgotten. They are the sound of a market, on the edge of telling a very different story than the one most investors are currently prepared to hear. The only question that remains is not whether this story will be told. It is whether you will be positioned before the telling begins.